In times of uncertainty, people often turn to things they can trust. Gold, silver are two of those things. For thousands of years, these precious metals have been seen as a safe store of value. Their shine represents stability when economies feel shaky. That human connection created a massive global industry. It is an industry filled with miners digging deep into the earth. But there is another type of company, one that profits from these metals without moving a single shovel of dirt. Wheaton Precious Metals is one of the largest and most important of these companies. We will look closely at how it operates. It is a business model different from traditional mining. We will explain simply what the company does and how it makes money. The goal is a clear and balanced picture. So, who is Wheaton Precious Metals? Wheaton is not a mining company. It does not own or operate any mines. It does not have fleets of trucks. It does not have teams of geologists on its payroll. Instead, Wheaton is a precious metals streaming company, one of the pioneers and largest players in this niche. Its business is built on providing money to mining companies. It acts like a specialized bank for firms that dig metal. This financial role is the core of its identity. Here is how streaming works. A miner might need a large amount of cash. Maybe to build a new mine, costs can be billions, or to expand an existing operation. The miner comes to Wheaton for upfront capital. In return for a large one-time payment, the miner signs a long-term contract. The contract obligates delivery of a percentage of future metals. Gold, silver. This creates a stream of metal to Wheaton for years, sometimes the mine's life. The second part makes it powerful. The contract sets the price Wheaton pays. That price is fixed and very low, typically far below market. Example: buy silver for about $5 per ounce, even if market is $25. Locked-in low cost is a fundamental advantage. Wheaton gets metal at a deep discount and sells it for significant profit. Different from a royalty. A royalty is a percentage of revenue or profit, paid in cash. Streaming means physical delivery of metal at a set price. Wheaton focuses on gold, silver, and also palladium, cobalt. This structure gives exposure to metal prices while insulating from rising costs like labor, fuel, equipment. It gets the upside of rising prices without the operational headaches. Let's get started and look at the facts, Wheaton's success is not tied to a single mine or a single country. The company has built a large and diverse portfolio of agreements that spans the globe. This diversification is a key part of its strategy to manage risk. Its operations are heavily concentrated in the Americas, a region known for its political stability and rich mineral deposits. Major streaming agreements are in place with mines located in countries like Canada, United States, Mexico. These are established mining jurisdictions with clear legal frameworks. Looking south, the company has significant interests in South America as well. Peru, Brazil, Argentina. These regions are home to some of the world's largest and lowest-cost silver and gold mines. By partnering with operations in different geographic locations, whether it is a labor strike, a technical issue, or a political change, Wheaton ensures that a problem at one mine does not jeopardize its entire business. This geographic spread is like not putting all your eggs in one basket. Section 4. The mechanics of profit. How streaming translates to revenue. The way Wheaton makes money is straightforward, yet very effective. It all comes down to the margin. Wheaton's low, fixed cost to acquire the metal, the high, fluctuating price at which it can sell that metal on the open market. Imagine you have a special contract with a farmer. You agree to pay the farmer $100,000 today. In return, for the next 20 years, the farmer will sell you 100 apples each year at 10 cents per apple. The supermarket price is $2 per apple. You pay $10 for the apples. You sell them for $200. Your profit is $190. This is precisely how Wheaton's business works, but with ounces of gold and silver instead of apples. The company pays a large sum up front for the streaming agreement. Then, for years, it buys ounces at a profoundly low, fixed price, its apple cost. It sells those ounces at the much higher market price. This wide margin is the engine of Wheaton's profitability. For example, average cash cost per ounce is around $450. The market price per ounce might be about $2,000. The world today, on October 12, 2025, faces economic questions. Inflation, geopolitical tensions, shifts in global trade make investors nervous. In this environment, companies like Wheaton draw attention. They offer a different kind of exposure to gold and silver markets. This essay will break down the model's strengths. It will also be honest about the risks. There are always two sides to the coin. The most significant risk is the price of the metals themselves. If prices fall sharply and stay low, Wheaton's margins would shrink. That reduces revenue, cash flow, and ultimately, stock price. The company benefits hugely on the way up, but it is also exposed on the way down. Another major risk is operational. Wheaton does not run the mines. It depends on the companies that do. In any of these scenarios, the mine would produce less metal. That means the stream of metal flowing to Wheaton would slow to a trickle or stop, hurting its income. Beyond operational issues, there is political and regulatory risk. Section 6. The road ahead. Wheaton's outlook in a shifting world. Looking to the future, Wheaton's outlook is fundamentally linked to the global appetite for precious metals and its ability to continue making smart deals. As of today, October 12, 2025, several key trends are shaping its path. The persistent global demand for gold-silver as safe haven assets remains a powerful tailwind. Ongoing economic uncertainty, concerns about inflation in major economies, a volatile geopolitical climate tend to drive investors toward the perceived safety of precious metals. This sustained demand helps to support higher prices, which directly benefits Wheaton's bottom line. The company's growth strategy is clear and has been consistent for years to add new, high-quality, long-life streams to its portfolio. The management team is constantly evaluating opportunities around the world. The key is to find the right projects with the right partners at the right price. Another important aspect of Wheaton's future is its commitment to sustainability and environmental, social, and governance principles. Modern investors are increasingly demanding that companies operate responsibly. This focus not only aligns with investor values, but also serves as another layer of risk management. Furthermore, as the streaming and royalty model has become more popular, competition has increased, which could potentially drive up the upfront cost of acquiring new streams. Conclusion: a balanced view of a unique player. Wheaton occupies a unique and strategic position in natural resources. Not a miner, covered in the dust of the earth. A financier, providing the crucial capital that brings mines to life. Through its streaming model, the company secures rights to buy gold, silver, other precious metals at a low fixed cost for decades. Profits come from the gap between that cost and market prices. Direct exposure to rising metal prices, while insulated from mine operating costs and risks. Strength: diversified portfolio, high-quality assets, partnered with reputable mining operators. Global footprint across stable jurisdictions in the Americas. But risk remains, highly sensitive to volatile metal prices, dependent on partners and political stability. For investors, a different way to participate: leverage to gold and silver, often with a dividend, and a distinct risk profile. Understanding its model is essential to this corner of the market.